So, okay, so those are the elements of the life cycle model. We're looking to smooth consumption over time. We talked about human capital and total wealth. Let's get into the principles then of life cycle investing.
So what are the principles? Now, during this presentation, our objective is not to give the mathematical equations and show how to solve it, using stochastic calculus. We just want to characterize what the solution is in a general sort of way. And I call these the principles of life cycle investing. So first of all, you always want to frame your choices in terms of objectives and constraints. That is to say, it's sort of the no free lunch principle. You're going to be constrained by your total wealth, by your income, and many other things. And the first thing you have to worry about in planning is that the plan you've come up with is feasible. Not necessarily optimal, but feasible.
How does one even know if it's feasible, though, without good advice?
That's where you work with an advisor, and you look at your assets, and you look at your income now and potentially in the future. So you do that analysis, and that's very valuable. Very few people do it unless they are dealing with an advisor. You kind of have to do some of it at tax time, okay? That's why I personally, as a practical matter, think that financial planning is best done at tax time. Because most people, my wife being an example, hate finance more than going to the dentist. They just hate it. So you try and minimize the pain. Smoothing consumption over time and contingencies, we've talked about that. You've got to frame the decision in that way, that, there are going to be a sequence of decisions, we set certain goals, and don't be fooled by inflation. This is my third.
Yeah, some people know you as the tips guy or the I-bonds guy. You're like Mr. Inflation, right?
My doctoral dissertation, which was written under the supervision or the guidance of Bob Merton at MIT, was on hedging against inflation. So and at that time there were no I-bonds or TIPS, Treasury Inflation Protected Securities. So what could you do? Okay, there really was no way of protecting yourself against inflation. That has all changed as a result of these innovations at the U.S. The U.S. Treasury was responsible for issuing these bonds starting in 1997. So it is very important, however, even in the absence of a way to protect yourself against inflation, to simply measure things correctly. Because, for example, if you're looking at your resources in the future, and let's say you've got Social Security and you've also got some sort of pension plan. Social Security, we know, has a cost of living adjustment clause. So it's in real terms. So if you expect to get, say, $1,000 a month, that's going to go up with inflation. We call that a real variable. If I'm going to get a pension, it typically will not, in this country, will not have a cost of living clause. So whatever dollar amount it is, it's going to stay fixed in nominal terms. We call that a nominal variable. If you're trying to judge whether you're going to have enough income to replace your earnings once you retire, you can't add those two things, Social Security and the nominal pension, because they're apples and oranges. One is going to go up with inflation, the other isn't. So one way to approach that, now the outcome of this problem is that financial planners, for example, who make this error, are telling people that they're going to be better off than they really will be. So you're building false confidence.
So because the nominal income is not going to go up with inflation, the real income like Social Security is, so you're protected there. I mean, that's, and I think this rolls into your next principle about, inflation is a big risk in retirement, especially if you've got nominal cash flows
Correct.
and you're not managing that risk. But how remind us, how does one
first of all, let
manage risk?
me make this following point. If you wanted to have a real pension adjusted for inflation, there are some insurance companies that will sell that to you today. But the starting level is going to be 2/3, if not less, of the nominal annuity. Mm-hmm. In other words, you'll get a lot less at the beginning because it'll be going up with inflation. And if you compute your replacement rate of salary using the lower number, you're getting a more realistic view of your income in retirement. Okay, so I say this, I emphasize this point because I know a lot of advisors, many advisors, who make this mistake. They don't automatically adjust. Okay. There are 3 ways to manage risk. Very important. Ask a typical advisor or anyone who is financially literate, how do you manage risk? Their gut reaction, wake them up in the middle of the night and put the question to them, they'll say, diversify. That's not the only way to manage risk. Investment risk or inflation risk, any kind of risk. There are 3 ways. And the other 2 are actually just as important, if not more important, for goal-oriented investing. One is hedging, and hedging simply means finding out what the safest way is to invest for a particular goal. So if it's retirement, it's going to be inflation protected. Bonds, a portfolio duration matched. An immunized portfolio, these are terms that are used in the institutional world to say you want to lock in, you get out of stocks and into these bonds that lock in a certain stream of real inflation-adjusted income. That's hedging. And it doesn't cost anything because you're just changing the allocation of your assets. Now, you're going to earn a lower rate of return, maybe not, because you're getting out of something that's risky and has an uncertain return. You're getting into something that has a fixed rate of return. Insuring is different from hedging in that you have to pay a premium up front. You have to give up something in order to eliminate the downside, but you retain the upside, or most of the upside. That's a very important type of risk management. In investing, that would be buying a put option on a stock portfolio to eliminate the downside risk. It costs you something. You got to pay for the put option. Okay. So these are the 3 dimensions of risk management. And in the usual discussion of asset allocation around retirement planning, the only thing you hear about is diversify, typically. Number 5, very important principle. Don't fall into the trap of thinking that stocks are safe if you have a long-run horizon. This is misleading advertising by the investment industry. Widely believed, including financial advisors, who say if the short run, you're investing for the short run, stocks are risky. Long horizon, you can't go wrong. They're going to beat bonds, for example, by a lot. Well, if that were certain, if it really were sure, then why would stocks offer a risk premium if they're not risky? It would be an arbitrage situation, okay? You'd always want, any long-term investor would want to swap bonds for stocks, push up the price of stocks. It's an impossibility, okay? Even from a theoretical point of view. I have written a paper in which I proved, using option pricing, theory and practice, that if you want to guarantee a stock portfolio against a shortfall relative to the safe rate of return, the cost of that put option actually increases with the length of your time horizon. Doesn't decrease, it increases with the square root of the time, the horizon date. So it's a fallacy to believe that the risk of stocks goes away in the long run. And I can't emphasize that enough.
Well, and Zvi, I know we've talked about this in the past, but so if the target date funds, for instance, in the early years, they're very heavily invested in equities, is that violating this principle?
No, it's not, because in the early years, most of an individual's wealth, a middle-class person, average employee, it's human capital. The amount in their retirement account is tiny compared to the human capital. Now, if their human capital is very risky, well, now we've got an issue. But for most people, it isn't. Certainly not compared to the stock market. And so you can afford, as it were, to have a lot of risky stocks in that tiny savings account. Now, as you approach retirement and you have a good idea of what your target income level is, that's when you want to hedge. Okay, number 6, a securities market price is probably a fair estimate of its value. Well, don't expect to find bargains lying there on the stock market. Maybe someone who spends 24 hours a day and is really a sharp analyst, a Warren Buffett or whoever, can beat the market. Most of us can't, and we don't know who can. So we're just better off assuming that there are no bargains out there, everything is fairly priced. Doesn't mean you don't want to invest in the market as a whole. But that's a very important principle. Beware of a survivorship bias in evaluating investment managers. Now, this is a pervasive problem that really fools a lot of people, okay? So you typically will read advice of the sort, look at a firm's track record to determine whether the fund can beat the market or not. Well, most of the reports that you see in the newspaper and so forth are based on a management company's existing funds. They don't tell you which funds have been shut down over the reporting period. And it's not a random selection. It's the ones that did badly. In scientific studies that are done, university, theses, doctoral dissertations, and so forth, we correct for survivorship bias. There are various ways of doing this. But if you just read the reports in the newspaper, the SEC does not require companies to correct for survivorship bias. So you're getting a meaningless picture of performance. That's not understood by most people, and it's very important. Certainly important for their financial advisor to recognize that. Take account of taxes, fees, and other transactions costs. Well, I don't have to tell advisors how important that is. Trust but verify the advice of experts. Typically, people are not experts. I know, for example, when I take my car in for repair, the garage can tell me anything they want, and I'm going to have to trust them. I mean, I could take it around to several and get opinions and prices, but I have to find a garage that I trust and ask questions, okay? I mean, there is such a thing as trying to verify that you're getting trustworthy advice. Same thing goes, I know I have this problem with my health care. I'm getting up in years. Various body parts are wearing out. I don't exactly know what to do. So what do? I see a doctor. He's the expert, or she's the expert, and I say, Doc, if you were me, what would you do? And the doctor typically says, I can't tell you what to do. You know, it's the same thing that a financial advisor has to say when asked, how much risk should I take? Okay? Okay, so
find a good advisor.
well, but it's
There
more
are a
than
lot
that.
of good advisors out there that we work with.
Advisor. I follow the rule of fiduciary. Okay, so I would always say, find an advisor who swears the fiduciary to the fiduciary standard, because at least in principle, they're legally bound to put your interest ahead of their interest. And brokers, for example, typically don't have to, they have a lower standard, suitability standard. So anyhow, that's important.